With three key messages we have to share with you this week. Firstly, we'll be looking at the tightening labor conditions in the US, as well as Janet Yellen's testimony before US legislators. And finally, we'll be looking at how our portfolios remain well positioned to benefit from the theme of reflation. It was another risk-on week from global equity markets. We have seen the likes of the Dow and the S&P 500 reach all-time highs yet again. This was primarily driven from very strong positive economic momentum that's coming out of these markets, as well as tighter labor conditions out of the US. And finally, Janet Yellen on Wednesday painted a very upbeat picture, which was favorable for these markets. On the US labor market front, in January, non-farm payrolls grew by 227,000, beating consensus estimates of 175,000. Unemployment in the US grew to 4.8%, up from 4.7% in December, and this was primarily driven from the increase in the participation rate, which meant more people returning to seek work, and the strong jobs numbers in fact suggested that this increased slack was being picked up, which is very positive. This week also saw Janet Yellen testify before the US Senate Banking Committee. She remains fairly upbeat about the state of the US economy, suggesting that gradual interest rate hikes would be appropriate should inflation numbers and unemployment numbers continue to meet expectations. This is in line with our Coutts House view, and like the Fed, we expect 2 to 3 rate hikes from the US this year. Moving on to portfolios, we remain well positioned to benefit from rising rates, rising inflation, as well as a rising volatility environment. On the rates front, we are underweight interest rate sensitive gilts as well as treasuries in favor of less rate sensitive corporate bonds, as well as alternative strategies, which we expect will outperform in a rising rate environment. So moving on to interest rates and how our portfolios are positioned, we continue to like equities, and equities have tended to perform best and see their price to earnings multiple grow when inflation is between 1 to 3%. And we continue to expect equities and companies to be able to pass on these rising costs to consumers, thereby protecting equity holders. In our portfolio, we also use real assets such as UK commercial property that we invest through collective funds, as well as commodities, both to hedge out inflationary risks. In particular, UK commercial property remains very attractive and is seeing very sound fundamentals as well as a growing rental income stream.